Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Last week, three of the big four banks, Westpac, National Australia Bank and ANZ, reported half-year profits. Add in Commonwealth Bank, which outlined its earnings 3 months ago, and the big four made cash earnings of almost $14 billion for the half. That's much better than 12 months ago during the height of the pandemic. And certainly the share prices of the big four reflect the improvement, with all of them up between 50 and 70% over the past 12 months. Along with BHP and CSL, the four make up the 6 largest listed companies in the country. They acted as shock absorbers during the pandemic-induced recession last year, postponing loan repayments for households and businesses, yet they remain somewhat unloved by the general population. To talk to us about the performance of the big banks, I welcome back to the virtual studio Tim Dring, Oceania Banking and Capital Markets Leader for EY. Tim, welcome back.
Great, thanks for having me on, Sean.
So, $14 billion in profits. It sounds like a lot between the big four, is it?
Look, it's a pretty good return, actually. They've bounced back pretty strongly from the half. Certainly for this time, 12 months ago, it's been a big turnaround. So that $13.8 billion in aggregate terms across the four banks is up 62% from this time last year. Our sort of numbers, when we go back and track sort of half-on-half performance, probably the highest one we've sort of got on record over the last decade has been about $15.7 billion. That was recorded back in the second half of 17. So, look, I think, 13.8, pretty strong performance.
Okay. Now, a few things I wouldn't mind just talking about. The three last week, ANZ, Westpac and National Australia Bank, all talked about credit impairment charges being lower and being able to bring back to the bottom line amounts of money which they had sort of put aside for bad loans. Just explain to the listener how that works, how they can suddenly take it from one account to the other account and make it look like profit.
Really good question, because that has been one of the big drivers of the earnings. And whilst the statistics include the four big banks, and timing is important here because CBA report their half a little bit earlier, 3 months earlier than the other banks. But so if I just take the last three that reported for their March half year, they've released almost back to the P&L, so a gain to the P&L, net of any other impairments that went through, of about $800 million. So that's a significant turnaround. 12 months ago, for their half, they put through, in aggregate terms, $5.7 billion for impairment losses. Now, that is based on what we call a collective provision. So that's a forward-looking provision based on losses that the banks anticipate losing over the duration of their loans, if you like. So what has occurred in that period is when they set that 12 months ago, there was a lot of uncertainty. COVID was on our footsteps, was the biggest economic shock predicted since the Great Depression. So therefore, their modelling took into account, I'll call it best case, worst case scenarios, if you like, and their base case, which had unemployment at double digits, it had house prices falling, and had GDP growth very, very low. So 12 months on, the economy has rebounded, and I guess there was always speculation how quick that rebound would be. So when they reset those forward-looking estimates for the collective provision, the economy is in much better shape. We've got now an unemployment at 5.6%, better than the government's forecast at 5.75%, and GDP growth tracking pretty well, and house prices double-digit growth for a 12-month period. In fact, we've seen the highest ever rise in house prices since 1988. They went up by 2.8% in March. So all of those economic settings have made those provisions, effectively were too conservative, if you like, back then. So there's more data, and as a result, they've readjusted their provisions.
Does that mean that those collective provisions, because you're talking about $5 billion plus, now we've brought back $800 million for the three from last week, does that mean there's more sitting there that could well come back into the P&L in coming halves if the economic trajectory continues as it is?
Yeah, good question. You look right across the board, the banks are sitting on about, $23 billion of credit provisions. Wow. And, that's pretty evenly spread right across the board of the majors, given the size of their books. So there's still quite a lot of provisioning sitting on the balance sheet. But I think, the banks are still cautious on the outlook, as we all are to some extent. Yes, the economy looks like it's rebounding, but the vaccine rollout is still in its infant stages. Our borders to Australia are still closed. we've seen just what's happened the other day just in New South Wales again with, the travel bubble with New Zealand being shut between New South Wales and New Zealand. So there's all those little factors that still leave the banks perhaps a little bit cautious about what lies ahead. And I think when you compound that with, other factors that are occurring overseas and also other sectors that haven't rebounded as quickly, such as tourism, hospitality, and transport, particularly air travel, there's certain grounds, I think, to be reasonably cautious, which is why the banks haven't released the full amount they put aside 12 months ago.
Stay with me, Tim. We'll be back in a minute. My guest this morning is Tim Dring, Oceania Banking and Capital Markets Leader at EY. Now, Tim, I want to get a bit pointy-headed here, and I hope our listeners don't mind, because I've got you here so I can ask you anything I want. And when I read bank results, there's a bunch of things that I kind of know about, but not really. One of the ones last week, Westpac and ANZ, I would have called them abnormal items, but they didn't call them abnormal items. They're kind of one-off costs or something National Australia Bank didn't have, and was applauded for it. Why is it that you can take it out of your P&L and call them something different?
Good question. I think, look, we're starting to see this concept that banks have worked to, a cash earnings, if you like. So effectively follow the cash versus statutory profit. Now, historically, analysts have been very focused on cash earnings. That's certainly what's driving their valuations and their models. And typically, the things that are going through the statutory profit line, but not the cash earning disclosures, are things like one-off items, whether it be asset write-downs that actually don't impact cash, but is just an accounting entry. So historically, we've seen those numbers been sometimes quite far apart with asset sales, write-offs, if you like. And you may recall a few years ago, the banks realigned their policies on amortising software. So, there were some one-off items in relation to that. But if I look at the difference between, for this half, of statutory profit that was recorded at 13.4 billion and cash earnings of 13.8, we're not that far apart. So we're starting, and frankly, that has been driven by regulators and scrutiny over the difference between reporting methods. And the bank's been more aligned now to be closer to statutory profit than cash earnings.
Makes it easier for we novices trying to work out what's going on. But one of the things that banks always talk about is net interest margins, which in my mind is effectively the difference between what they pay out on deposits and receive on loans. What's happening in that net interest margin world?
Look, over the last decade, Sean, net interest margin has been declining half on half, this steady decline. A function of that is the low interest rate environment. That is the big driver of it. And we did see, once again, in this half, it falling by 6 basis points from the same half in 2020. So, that's a function of pretty competitive pricing out there, particularly in residential mortgages, where, typically the margins have been slightly high, but it's highly competitive. What we are seeing, perhaps some green shoots for the banks here, in the last few months of this half, we have seen, for some of the banks, margins starting to flatten out and, in fact, improve. Now, that's been driven by a couple of things. One is still we've got competitive pricing, but we've been repricing, banks have been repricing deposits and accessing cheaper funding, hence some of that margin is starting to pick up a little bit. So we might see over the next 6 months, that start to bottom out and maybe bounce along that trend line or even slightly pick up a bit as certain products, both on the liability side of the balance sheet and on the asset side, get repriced.
Okay. Now, another thing that the banks all talked about, and Westpac was a prime example, is cost cutting and the idea that they might have some sort of target to achieve. And I think from memory last week, Westpac was 2 billion by 2024. ANZ said it wasn't going to have a target, but certainly was keeping an eye on costs. Does that suggest that in terms of getting a better bottom line, the banks now are relying more so on cutting costs rather than system growth?
Yeah, look, I think that's a factor. And prior to COVID, we were in a low growth environment. Yes, we are getting some uptick on growth, but the bank's loan growth is still tracking just below system for the big four. So they're looking to try and at least get back to system or beat system over the short to medium term. So therefore, what other levers do you pull? Costs has been a function that banks have been focused on for a while. two things I think playing out there. One is simplification of the bank, so simplifying systems and processes, trying to automate processes, reducing I'll call it their real estate footprint. So potentially the branch network looks smaller, taking costs out again. And that's been, we've seen evidence of that through COVID, where customers who haven't transacted in a digital format are now doing so, hence less reliance on the branch network. So there is this, I'd say this ongoing drive to take cost out of the business. And we have seen some of that come to fruition in this half, where costs were down about 4%, and cost to income ratios, which is a key metric on a bank's efficiency, has improved. So that ratio has improved from 53% to 51%. Now, going back some time ago, that number was in the 40s. But the income line was slightly different. So banks want to become more efficient, further investment in technology, further investment in process automation, and investing that to drive costs out in the short to medium and long term.
Okay. So boiling all this down, how do banks make money? Do they make more money in mortgages? Do they make more money on credit cards, business lending? Is it in wholesale markets, investing, kind of big credit provision for mergers and acquisitions, and in fixed income markets? How do they make their money mostly?
Well, it's a really good question. It is about how you allocate capital across your most profitable segments. And, banks have been very focused on what segments they concentrate on then also what customers they concentrate on in those segments. There's some customers that are more profitable than not. So, there has been, I won't say shrinking to greatness, but right sizing the portfolio to become more profitable. The more riskier assets a bank does hold, the more capital it does need to hold against them. So typically mortgages, where there is less capital deployed.
So essentially what that means, though, is that if you lend out for a mortgage, there's less risk, so they have to have less money in reserve. So a mortgage is a safer
loan, so for the bank. So therefore, typically they're holding less capital. Generally the margins are pretty good, so that's typically a more profitable product. Cards, as an example, unsecured, but they charge a higher rate of interest because it is riskier. So, the returns typically in that product line are, can be quite profitable as well. SMEs, tough, certainly a riskier portfolio, different type of lending, different margins. So that's how banks generally look at things. And then you've also got the institutional bank, which, comprises of both, bigger business, bigger corporate loans, really. But then you're competing with different players. Compete with big inbound foreign banks, etc. So it's a different sort of equation. And once again, a lot more capital being required against some of those loans as well.
We'll be back with more in a moment. I'm talking to Oceania Banking and Capital Markets leader at EY, Tim Dring. Just before we wind up, I just want to talk to you about ESG, that's environmental, social and governance factors, which you've spoken about before. Certainly the banks seem more interested in that area.
Yeah, look, they are. And I think there's a number of factors driving it. There's no doubt they are very much focused on their customers' exposure in this area, particularly those with a big carbon footprint, and what that looks like for them going forward around their credit risk and their underlying business profile. You've got regulators now taking a very keen interest in it. APRA recently released their Prudential Practice Guide on how to manage, ESG and climate change risk. You've then got shareholders, institutional investors, being very much focused on where banks are deploying their capital, who their customers are and who they're lending to. And you've also got customers also having a similar concern as well. So there's a number of stakeholders the banks needs to manage. And for the bigger banks in this country, they play across a lot of geographies. So you've got a lot of political exposure, different economic policies, different climate change policies coming out of the countries where they operate and where their customers operate.
Do you think the banks will ever recover from it's not quite the Royal Commission because it's going on for a long time. Why is it that the Australian population doesn't seem to like banks? Now, having said that, they're all going to increase dividends, so we're probably all a bit happier as shareholders now. Is it just, you're a bank, you're always a bank?
It's a really good question. It's a bit like saying I'm an accountant. What do they think accountants are boring? Who knows?
Tim, don't be silly. Don't be silly.
I think it's one of those things. Look, they're an important part of our economy, a critical part of our economy. We saw how important that was, the stability of our sector through the GFC. I call it this love-hate relationship. Most customers generally like their bank but don't like banks as a rule. So, it's a hard one. We've done a lot of surveys in this space, and the data does support. I love my bank, but banks as a whole probably not as keen on. So I think it's the stigma that goes with it. As I said, they do play an important part, and I think when people sort of peel back the onion a little bit and probably look at it with a more rational focus, you can get to understand that they are so critical to what we do. They are so critical. They're the glue and the lubricant at the same time in our economy.
Tim, I've got to say, I have good relations with 3 of the big 4 banks. Don't like that other one, but the 3 I deal with, I really like. They're always providing great service.
There you go. That's right.
Tim, thanks for talking to Fear and Greed.
Great to catch up with you, Sean. Thank you.
That was Tim Dring, Oceania Banking and Capital Markets Leader at EY. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.